The number of public companies has been shrinking, sending investors looking for diversification in the private markets. But as the lines become blurred between public and private markets, do the potential benefits outweigh the risks? CNBC's 15th annual Delivering Alpha conference brought together some of the biggest names in investing to help make sense of it all. This is Inside Alts.
As we think about opportunities, there's been a lot of discussion about how much is in the public markets versus how much is in the private markets. How do you think of that? How do you think about that? I know, obviously, General Atlantic is primarily in the private markets. Coatue, a little bit of both.
A lot of both. No.
A lot of both. Do you agree with the notion that the private markets are where the opportunity is right now, or do you feel like there's there's a blurring of the lines between the two, and that you can find opportunity anywhere?
Well, I'm glad to have friends like Philippe so I can get insight in what's happening in the public market, because we do focus on privates. But I think you have to understand both. As I was saying earlier, I really believe right now that the people driving the change in AI are the large public tech companies, and I think the incumbents have that advantage. So if you don't understand what Oracle is doing, what Google is doing, what Microsoft's doing, you really can't invest in the private market. You really can't make good decisions. So even if we're not making investment decisions on the public side, we have to be pretty fully aware of what they're doing, and that's how we synthesize it into our decision making.
Yeah, and in our company we do everything from seed to privates to publics. On one hand, you could say, okay, maybe we're at an advantage because we know both about publics and privates, but on the other hand, the mindset to invest in publics and privates is different. Mm-hmm. I would say sometimes the mindsets of public and venture can be the same around thinking about big ideas, but on the public side, it's not only you have to believe in the future, but you have to think, but is it already priced in or not? Like when Oracle goes from 50 to 350, at 350, it's like maybe the idea is already priced. And on the private side, because usually things take longer, you have to be more right, you have to be more patient, you have to be active in your companies, you have to support the founders or the CEOs a lot. So I would say that if you can do both, great, but they're definitely a different skill set. Yeah. Sometimes I wish I was only in one or the other, sometimes I'm happy to be in both.
The nice thing about private is just, as we were saying before, I think this tech cycle plays out over a longer period of time, and I think there is a duration that you get from being a private investor, more of a 5 to 7 year horizon that allows you to sort of play the cycle a little bit longer than sometimes the public markets are more demanding for shorter term performance.
Do you think it makes sense to fix the IPO process if the IPO process is broken? Or does it make sense to democratize alternatives to give more retail investors access to private companies, given just the leg of growth that they're in and that companies are staying private for longer, and you have OpenAI valued at $500 billion at this point as a private company?
I personally think that the IPO market is totally broken, like beyond repair, as measured by the fact that 20 or 30 years ago, there were so many more IPOs than today. Today, there's very few IPOs. We were talking earlier, this year there's been almost none. And I think it's not a great trend, because at the end of the day, it's just easier for a retail investor to be involved in IPOs and then onwards than everything before the IPO. So I find it's a little bit unfair. I do think that it's going to get fixed purely through competition more than through a regulatory action, because when private assets get tokenized, the byproduct of being tokenized is you in essence become public, because now you could trade at a premium to the price of the token, you could trade at a discount to whatever the token price was issued. Yeah. And so all these people that are privatizing, tokenizing private assets, in essence, it's making them public. And so I think that one day maybe all assets are going to be public and tradable, to the point that maybe some companies then are going to miss, like, oh, I wish
I was
we were not tokenized. And I think there's going to be a battle between companies that choose to be tokenized and some cases say, I don't want to be tokenized. I don't want to be subject to the whim of investors putting a daily, maybe on a per second value.
Per second. I'm a little more optimistic about the IPO market. I think we've had an exit recession in private markets for the last 3+ years, and some of that was regulatory, some of it was just some of the trends that Philippe was talking about. But I think we started to see some green shoots around the IPO market this year, and it was just unfortunate that the wind was taken out of our sails a little bit when we had the government shutdown. There were a lot of high-quality companies on file, ready to go, that would have gone public in Q4. I think built some momentum going into 26. That got stunted, and I hope it'll come back. I think it will come back in 26. I think there's still, while the balance may have shifted towards privates, I think there's a desire among public investors to have high-quality companies come public.
As we think about the retail investor, one of the key topics in our world is how they diversify into alternatives, which has been a big topic of conversation. I know Ares is big into this. JP Morgan does this through third parties as well as your own proprietary products. How should we be thinking about that against this backdrop of risk management? How should investors be, as they start to kind of dip their toes into alts a little bit more, semi-liquid products, how should they be thinking about ways to risk manage that and do due diligence?
Want me to start us off on this?
Absolutely.
So this is an area where we partner at an extraordinary level. I'm a happy client for many, many decades, and obviously we sell a lot of our semi-liquid product through the JP Morgan channel. I think whenever you talk about retail access to any investment product, I think Mary's point is spot on. You have to focus on fiduciary duty, and you have to make sure that they understand what they're buying. Now, I also believe that sometimes we don't give the everyday investor enough credit for just how smart they are. I've had a situation where I walk around with an Ares logoed sweatshirt, and someone stops me on the street and says, "I listened to your earnings call. Don't cut that dividend. My retirement is supported by it."
Wow.
And you meet those people and you say, well, that doesn't sound like someone who's being sold something that they don't understand. As a capital markets practitioner, I just think any time we can increase access to the individual investor to investment product that will help them through their wealth creation and retirement is a good thing. And it's finally here where the purview of the institutional investor, private equity, venture capital, there's no reason why the retail investor should not have access to institutional quality product as long as it's structured the right way and they're well advised. So a lot of what we partner on is not just the product, but the education of the advisors, the education of the end client, an understanding of the risk. But when you see what alternatives can do mixed in with a traditional 60-40 portfolio, it's a wonderful thing.
Absolutely.
And you're going to see a continued increase in retail buying of alts because it delivers a better investment outcome in most portfolio constructions.
And that's exactly why the current administration is changing the rules on these things so that you can think about having them in 401k accounts, that you can think about them in the Invest America accounts that will come for the children's future so that they can participate in 99% of the companies out there in the United States of America that are not public. And so why should it be that just institutions get to invest in the things that are not public? And when you're not public, you're not paying a public markets premium, and so there's great value to be found. How do we give that access while properly risk managing it? And so there just should be no such thing as a public markets only portfolio for almost anyone in the world if you can risk management. It should be a public to private continuum. That's how you should think about it. And how you invest that money is just right-sizing the bite size of it, risk managing it, and making sure that everybody has access to these companies. It's just a fabulous opportunity, and it exists on the credit side, and it exists on the equity side, and everything in between.
Yeah. I think the unlock, sorry, Leslie, one that, which is when you go through cycles, and this is not meant to sound paternalistic when I just said that we need to trust the investors more, but what the semi-liquid structures actually do is it allows you to own these assets through a cycle to capture all of the value creation. And ironically, when the market is going through volatility or a downturn, there is no liquidity at the price that you want it. And I think that institutional investors figured that out a long time ago. The retail investor has been trained for generations. Don't lever yourself. Yes. And be liquid, because when things get bad, you need to be able to sell. And inevitably, they go sell the things that they can, not the things that they should.
Exactly.
And I think what we're now seeing, and I think it's why we're seeing the market smoothing, the ownership of these assets, you're almost structuring out the bad behavior, because people are doing a better job understanding the liquidity and how much they can give up and get paid for it.
And the sophistication of evergreen funds, interval funds, things that can last through time. We were just talking about some assets that we share and own. And you think to yourself, why should I have to sell that every 5 to 7 years to somebody else to put it in their portfolio if there's an end date to my private portfolio and the thing isn't going public, so it's not going in the public markets, but I want to own it forever and it'll have an appreciation, and I don't want to necessarily have to deal with a mark to market at a particular time that the fund has a maturity date. So all of that leads to more of this stuff being put in portfolios. When done with the right bite size, makes a terrific opportunity for the rest of America and everybody else around the world, but you know that those are the opportunities you can afford.